When you combine dogs or pets and recurring revenues, you got some very powerful combination to make yourself rich. In today's video, I'm going to talk about Bark Inc. and whether it's a good deal at today's prices after the stock is down about 85% from its highs. If you're new to this channel, my name is Mariusz Konieczny. I run Microcap Explosions, a website dedicated to microcap stocks which are ignored and underfollowed by the investment industry. I also wrote 10 books on investing, one of which is available for a free download at microcapexplosions.com. I also created valueinvestinguniversity.com, which is a free resource to make you a better and more intelligent investor. I have to say that I was very excited. I was very excited to have a look at Bark Inc. after big sell-off of about 85% from its highs, and looking at the financial statements, the company looks cheap. So just quick overview. Bark Inc. is a subscription-based business model where if you have let's say if you have a dog, you can order from them on a monthly basis, like a box where you pay like $20 to $30 a month and you receive a box, and in that box you get toys for your dog and treats, and that's one particular type of box. Then they have other boxes that are dedicated for like health, that you can get like a toothbrush for the dog, and then the company is also doing box for food, also on a subscription basis. So I absolutely love this kind of business model. Anytime you have a subscription business model that is recurring every January that comes, you don't start from zero. So wonderful business model, and that's what made me want to look into this. Because of where the company is trading, let's quickly take a look at the financials and how they relate to the market cap. When you look at the company's stock price, it reached a high here of close to $20, and since then it's a continuous slide. So it's almost down about 85%. The market cap, as you can see, is about 500 million. That looks pretty reasonable on surface. This is the 9 months of 2021. So if you take 378 million, which is here, and you annualize it, you get revenues of about 500 million. So it's trading at 1 times revenues. For a growing company, this is not bad at all. Now, let's take a look at those revenues. What's the quality of those revenues? Well, from the point of view of gross margin, we take 218 divided by 378. These are some serious margins, 57%. So that's a good gross profit. Now, here's the problem though. You see the general administrative, they're absolutely humongous. They are almost 100% of gross profit. And it's always like this. Here, in the first 9 months of 2021, first 9 months of 2020, here it was a little bit better. If you look at the 3 months of the last quarter of 2020 in comparison to this last quarter, almost 100% of gross profit is spent on general administrative. We're not even talking about advertising and marketing, which is a little bit more. So some investors are actually saying that there's something fishy going on, that they are not breaking down the general administrative. And some people actually think that some cost of goods sold that should have been included in the cost of revenue, it's really dumped into general and administrative in order for the gross profit margin to look better than what it is right now. Of course, there's no proof for it. However, when you see Bark CFO stepping down, it's possible that this is exactly what's happening. So as you can see, the company's market cap is very, very reasonable in relation to the revenues, and purely based on the gross margin, those revenues appear high quality. Yes, I said that the general and administrative make it look like there's something fishy there because so much of the general administrative is spent, because so much of the gross profit that the company generates is spent on general and administrative. And as a result of this, the company is not profitable, which is not too big of a deal for growth companies as long as there is path to profitability. Now, before the sell-off, of course, the company was trading at much higher levels in relation to revenues, in relation to future potential cash flow or net income. And today, it looks like it's cheap. I always ask myself, financials are financials. I want to understand the business because the first thing I want to know is, do I even want to be involved in this business? So I was excited about it until I heard this customer talk about why he canceled the subscription. So have a listen to this.
What's up, guys? And as you can see from the title, we ended up canceling our BarkBox subscription. It is a subscription-based company. You pay every month. They send you some gifts for your pet inside a box. The reason why, this is one reason. Yeah, you just get way too many toys for one dog. This is another reason. Yeah, you just get way too many treats for one dog.
So he cancels his subscription. And it makes total sense because imagine yourself, you have a dog and you have this monthly subscription and you get toys every month and treats every month. How many months is it going to take you before you're like, my house is becoming like a garbage can? I mean, how many treats and how many toys does my dog need? Every month you get new ones, and it just piles on. And at some point you're like, you know what? I'm just going to cancel it because it's too much. So the wonderful business model that this appears to be, recurring revenues, doesn't appear to be that great because you only satisfy your customers for about 4 to 6 months. And you can see it actually from the company's investor presentations. You see, it costs about $50, 50, to acquire a customer. And that customer used to spend, or the value of the customer over the long life of the customer used to be about 10 times the cost of acquisitions. So you pay $50 to acquire a customer, and then that customer over time would spend about $500. Now that number is about half. It's coming down. And it's already below 5. So instead of the customer spending $500, the customer is only spending $250. And it makes absolute total sense because of the fact that you get so many toys. And at some point you're like, I have too many. And that's why this gentleman canceled his subscription. And I would say this is the most important thing about this thesis. And yes, I do understand that this is one type of box, but this is the majority of the revenues that are created from those toys and treats. And the company is trying to go out and send you a box for food. But then you're entering into a totally different competition. There's plenty of pet stores. You can get it at Target. You can get food for your dogs everywhere. So whether that box eats is going to succeed, and right now it's such a small portion of the revenue mix that I'm not willing to pay for that. You tell me if this is a good business model. You come up one day and you wake up and you're like, I have this idea. I'm going to be shipping boxes of toys and treats to my customers every month. And from my point of view, it's wonderful. It's a recurring business model. The customers are going to pay me every month. It's wonderful. It costs you $50 to acquire a customer, and then that customer sticks around for about 6 months. Do you think it's a good business model? Do you think you're gonna get rich off of it? I don't think so. I don't think it's a very good business model. I wouldn't get into this business myself. So why would I want to get involved in owning a stock in a company like this? Oh, because it's growing and because at some point in the future it might be profitable. I don't care if it's growing. I don't like the business. So for me, on surface, it appears that this is a great business model because the margins are huge, but they might be overinflating the margins because they might be dumping the true costs into the general and administrative. And as you saw, the management is like a revolving door in this company. CFO left, other people are leaving all the time. So on surface, it looks good. Once you start peeling the onion, the business model doesn't appear to be that fantastic. So yes, it's trading at 1x revenues, but do I even want those revenues? I don't, but maybe you do. You see, recurring revenues are wonderful, but they're only wonderful if they can be sustained. Let me give you an example from my life. We were buying apples directly from the farmer or a producer, and we would only buy apples like as much as we needed. But that producer wanted to have more certainty about a revenue or income stream. And at some point what he did was he forced everybody to buy a certain quantity of apples on a monthly basis. So you pay him a monthly amount, and then you had to go and pick up, or they ship it to you, like a basket of apples. And we did this for about 2 months. And then we were like, we just can't keep up with these apples. We can only eat so many apples. And then so we ended up canceling. From the producer's point of view, he wanted stable income, recurring revenue, because that's the best revenue model. But it didn't work for the customer. And that's the same thing that I'm seeing here, is that Bark Inc. wants that recurring revenue because recurring revenue is valued higher in the stock market, is preferable in the stock market, and with such high profit margins, this looks wonderful on paper. But then when you go and look at it from the point of view of the customer, it doesn't look so wonderful if the customer cancels those deliveries after 6 months because the dog has too many treats or too many toys. It just simply doesn't work. But this business model could work if, let's say, those treats disappeared or evaporated. Then it would work because then you would just keep replenishing them. That's why something like this for food, it might work better than for toys. But of course, those toys don't disappear, and then the owners are stuck with the problem. What do I do with all these toys? Do I throw them away and pollute the environment? Do I give them away? Or the easiest way is to simply cancel the subscription. Now, let's talk about, for example, a company like Globex, which I am involved in. And if you are interested, I would suggest you watch a playlist that I created on Globex. It's a similar situation where Globex and Bark have a recurring business model. On surface, it looks the same. It also costs a certain amount of money to acquire a customer for Bark and Globex. So what Globex has is a private and secure email and messaging communication. So I'm not going to say anything more. It's a private email and private texting, okay? Like truly private, so no data mining, you're not going to get hacked very easily and things like that. And you pay a recurring revenue like $10 a month to have your email and messaging platform. And it costs a certain amount of money to get a customer, okay? But now you spend that money and that customer stays. That customer is gonna stay for years. It's never gonna be like, oh, I have too much email, I'm getting too much text. No, because it's electronic, right? So that customer could stick around for 2 years, 5 years, 10 years, not 6 months, because you continue using the email, you continue using the text. So that investment to acquire a customer it's a great investment. And margins on that kind of business are like through the roof, like in the 90% for email and messenger, because it costs so little for storage to maintain it. But the difference is humongous. One, it's a great investment, the customer stays for years. Another one, the customer gets fed up with it, too many toys, and cancels it. So this is a difference between qualities of businesses and qualities of revenue streams. It serves you well when you understand what it is that how the business operates, and if you can understand from the point of view of the producer providing that service and then the consumer receiving that service. In here, it's a night and day. And for me, at the beginning, I was excited about Bark Inc. because I love subscription business models. I love high gross profit margin businesses. But then after I started investigating it more, I'm like, no, this is not the business that I want to get involved. It's just not a very good way to get wealthy. I would prefer businesses that are, have better economics, and those are the ones that I want to go with. So hopefully you enjoyed this video. Hopefully it made you understand better on how I look at businesses and how it's important. Forget the hype, forget the valuation, whether it's cheap or not. Yeah, of course, Bark stock can go up, but I first want to like the business. If I don't like the business, I'm not interested no matter what price it's trading at. So thanks for watching, and please subscribe to this channel. Click on the notification button, like the video, share the video, and share with me your comments whether you think I'm correct on this or whether you think I'm missing something.